Welcome to the blog for Monday, the 20th of August. So this is day 51 of 65 of the Compound Effect Challenge, starting the 11th week out of the 13 weeks or 3-month challenge. The idea of this is just to be doing the little things every day. When reading the Compound Effect, the book, he talks about no matter what you're trying to achieve, whether it's a business, trading, lose weight, whatever it is, it's the little things every day that matters. And he says, how simple it is to do little things, but what actually happens also is, it's actually really simple not to do them, and quite often don't realise that how much of an impact the little things have. So this challenge is purely just to make sure I'm doing the little things every day, and just let them combine and compound to really move forward and make progress every day by applying my engine method. And now that I'm getting towards the back end of it, I think back to where I was and to where I'm now in relation to some goals and what I'm trying to achieve through this, and it just makes such a difference, major difference. And something just on a personal note, something that I also do just to really try and consolidate some really good habits is actually taking a few different areas of my life. So, for example, health, giving myself an eating plan and an exercise routine as well, and setting it for myself and saying, well, if I skip any of those things, or don't do any of those things each day, I'm actually failing on myself and what I'm trying to do in my trading. So by applying some goals as far as exercise and eating, I apply them to my trading, and that actually drives me, makes me want to do it. So it's interesting. I just thought it's a good point as far as incorporating a few different areas of your life, and that really consolidates what you're trying to do. I know, personally, it's worked quite well for myself. As far as the trading plan goes, this is another section of the year. Basically, we're in these slower markets, and these markets by no means it's like we should consider taking any less profit. That's definitely not the case. Yes, there's slightly less opportunities. I'm probably taking maybe half the trades, but definitely opportunities, and opportunities, I'd say just about most days. But even though there's slightly less opportunities, there's not it's not a reason to not profit or make profitable days from these markets, profitable weeks, profitable months. What's really important is to understand what you're trying to achieve within a year. For myself, I don't get too concerned about day to day or even week to week. What I really start to focus on or set goals for is month to month. I have month to month target, but then ultimately it's all leading up to what I want to achieve within a year. So it's important in these slower times that you really stick to your strategy and understand that these markets potentially out of a year, we could have 2 to 6 months of these type of markets. So it's important that we understand and learn how to trade all the different markets, and if we and focus, I guess, in these type of conditions, and realize that you can keep on achieving and moving forward on your goals. It just means having a slightly different way of approaching the markets. And for me, it's understanding that, for example, today, and then we get to kind of the overall view of today. It's opportunities are still going to present, but you just have to be prepared to, or realize that they're going to take longer than what they normally do. When I look at this 5-minute chart compared to 1-minute chart, for example, I think, for me, it's quite easy to just trade the 5-minute chart because that's what I've been trading. But even for those that say stick to more to the 1-minute chart, and I certainly do use the 1-minute chart quite a fair bit. But if you look at the 1-minute chart, very very slim movement, but very hard to pick the opportunities there. Whereas you go to a 5-minute chart, obviously it's the same move, it's just been squashed up, but there's still opportunities there. We just have to be prepared to wait and execute some patience and let them play themselves out. And the thing about these slower markets is the markets, I guess, because they're moving slower, has a little bit more time to understand and respect certain areas, so they tend to stick tighter to their formations and support resistance areas. So even though there's slower markets, less opportunities, there's still some fantastic trading opportunities just because of the way that the market sticks so tight to its true form. That's what I've been finding with these slower markets. So still looking at the opportunities every day. However, I would point out that it gets to a certain stage where once the range really starts to tighten up, for example, you could split this day into two halves, obviously the morning session, the afternoon session. The afternoon session almost got to the stage where it really was getting too slow. In saying that, throughout these markets, I guess most opportunities will come in the morning. And if you look at it from a macro perspective, I think when traders look at these slower times, I think they're prepared to trade the mornings and either have the afternoons off or just maybe sit and watch a little bit in the afternoon. So for that reason, there is a little bit less volume and movement in the afternoons. Doesn't mean there won't be a trade if the right opportunity comes, but for myself, I had three trading opportunities in the morning. One of them I took, and I'll explain the other two here. And there's another one here I was very close to getting it as well. But then come the afternoon, there was basically 4 trading opportunities. I'll go through these as well. But by the time the afternoon comes, the market was really slowing down, and even though there was actually physically some setups for me, I let them go just because the range is so tight. So I guess it's about having a balance and just knowing exactly what works for you and how you're going to approach the markets. So as far as today, I've drawn a breakout box, so a box around this pre-market data here. So you can see to start off with, I had this entire box drawn up here. So here, the pre-market is basically a 6-point spread. As the market came down towards this area here, not looking at if it had a broken through here, certainly not looking at trying to get some sort of sell here, just because the Nasdaq and the Russell yesterday were pushing straight through. But the Dow Jones was really trying to resist the upside, and it was bouncing, and it was looking like it had some really strong support all through this area here. Just didn't want to bar the downside, so for that reason, didn't have that market support as far as the downside is concerned. The market then started pushing up. It sort of started bouncing around this region here. You can see clearly, that's another area where it's getting resistance from this pre-market. So because it's a slower day and a tighter range, getting up towards here and then using that as some sort of support to break from is just, it's almost impossible because we've got such tight daily ranges. Bit of a mouthful, that one. So I'll go ahead there, and you can see there's definitely some strong pre-market resistance there. So if we're getting above it, then use it as support to go higher. So I was then prepared to draw that in, and I was looking at the opportunity here and very much prepared if it pushed 4 ticks past the area. That's the rule. Come back, put the order on, use it as support to continue up higher. Because at this stage, all the other markets were starting to get some momentum on the upside. In the end, it couldn't get through that region. So the fact it couldn't get through, it no longer, it's not going to act as support. So just let the area go. And the market then come back down here. Now this is a different time. It came back a second time. I talk about it when it comes to second time being a lot better opportunity because it's had some time to really, I guess, think about the area. If they're coming back a second time, there's a good reason for it. This market started pushing through. So here we've got 3-4 ticks here. We've got 3-4 ticks through here as well. But if you watch the Dow Jones, again, it just wasn't. It was holding. There was support in the region. And then it wasn't until it actually started pushing through here that all of a sudden, and I'm just watching, like all the markets are getting some momentum on the downside, but it was the Dow Jones that it was waiting and holding, and then all of a sudden it started to push through and break through that, what was a support. And let me just quickly bring it up so you can actually see it. So here it is here. So it wasn't until it started getting down through here, this is when it started breaking. You can see how it just kept on bouncing, just didn't want a part of the downside. Then it started breaking through here. So this is when it was the signal that there was market support, and it was operating together on the downside. So looking for it to pop back and get the order off the resistance here. Use what was the support now as resistance. So the order was sitting there waiting. Unfortunately, just missed it by 1 tick, and then it went through exactly 10 ticks. So I would have been going for about 10 ticks. So possibly would have been a break-even trade anyway. But as said from the last week's session, you're going to start talking a lot more about exits, because exits is a major part of trading. You need a complete trading strategy for exits. Professional traders will say that whatever you do for entries, spend as much time, again, or if not more, and as much detail on creating an exit strategy, because it's the exits that are ultimately going to create profitability within this market. So this particular area here, especially in these tighter markets, we're looking to take out 5 ticks, letting the second, so that's a third at 5 ticks, the second third of contracts go somewhere between 8 and 10 ticks, and then the final third of contracts going, possibly 10 ticks or more, depending on the area. So this particular area, actually, this is a good time to bring up the 15-minute chart. So here it is, 15-minute chart, and what I was looking at in regards to here, the first thing is it's got this trend line in here, and you can see going back through the times, the market's always reacting to some sort of trend line. This one here was a fantastic one. It reacted to it. It's one I've kept in the marketplace for a long time, kept coming back and hitting it. But basically throughout these markets, there's always some sort of trend line. I'm not necessarily physically trading the trend line, but I'm using them as a guide to give me an idea of direction. Okay, so 15-minute charts for myself is a great link between the daily and the short term, or the charts that I actually trade. And this gives me an idea of where we're heading. Okay, so I've got this little bit of a support region in here. This is not a key level, it's just that over the last 2 to 3 days, and that's why I like to use these charts, because it kind of gives you the information of what's happening over the last couple of days. It gives you a little bit more of an overview of what's happening. I'm looking at two things. For one, we've got a really good rejection of this trend line and heading down, so that's some downward pressure. The next thing I want to see is it break through this support area, which is held for like the last 2.5 days or so. Okay, so the ES was starting to try and get underneath that. In the end, it's got to bounce. But I'm keeping an eye on this, and I'm watching this. And if we got underneath and start using it as a resistance, I was prepared to let that breakout trade, which I did get filled on, prepared to go. But I'm just showing you, by keeping in mind some of these longer term charts, this was an area where I had an opportunity to go for more, but in the end, it just couldn't get underneath and use the resistance, and came back up above it. Which is another point, that once we got above that, you can see straight away then it's usually the support to go higher. You can see it's bounced off of there. This is a real changing of momentum, and from there the market is getting some momentum on the upside. So with that in mind, it leads me to my next area, which is this particular one here. This is the reversal. Okay, so the market's come down, we pull back. This is an area now where it should start to head to the downside. The predictor is pushing down. We've left a nice little pivot here. So, if the markets aren't going to go down, there's also going to be a change of momentum once they start breaking through that pivot. That's the area I want to be a part of. But of course, need the Russell and the other markets already pushing through this area here. So if you had a look at the other markets, the Nasdaq was the first one. It was well and truly through. Then the Russell started pushing through. Once the Russell started breaking that pivot, I was able to put the order on then and buy at 14.13, so right at the pivot area. So this particular one, in overall got 1 tick. So as far as my exit strategy, what I was doing is because it is a bit of a tight market, really just taking out a third of my contracts at 1R, or meaning what I'm prepared to risk, taking out for profit. So if I'm risking 5 ticks, I'm taking a third of my contracts out at 5 ticks. As soon as I get it out at 5 ticks, I'm then reducing my stop to a minimum of 4 ticks. So what that means is when you break it all down, if it comes back and stops me at 4 ticks, well, then I've got a 4 tick loss, a 4 tick loss, and a 5 tick gain. When you average that out of my contracts, it adds up to a 1 tick loss. So I'm getting to the stage where it's almost break even as soon as it goes 5 ticks. Okay, so it's not, I don't like to just all of a sudden keep on reducing my stops. I don't want to say, as soon as this goes, say 3 ticks in my favor, reduce my stop to 2 or 3 ticks. I still want to give it the room, but I'm taking some of my contracts out, and that automatically starts reducing my risk. It's just a different way of approaching it. I'm still giving the trade room by taking contracts out. And then basically the second third of contracts, I was looking to get out at 10 ticks, which is 15.50, and I was actually looking to get the last third out too. So I basically had the rest of the position waiting at 15.50 to exit out at 10 ticks, just because it's not the area to be trying to be sneaking out more points, because it's just for me, looking at the 15-minute charts and a few of those, it's not the right area. There's not potential for it just to keep on going. So unfortunately, there it hasn't quite got to that profit target. But what's happened is once it's gone 7 ticks, it hasn't even got to the break-even stage. But I had reduced my stop to 1 tick below this area through here, so I ended up getting 2/3 stopped out 1 tick and 1/3 stopped out, or profit 5 ticks. So overall ended up being a 1 tick profitable trade when I average it out over all the contracts. So small win or break even trade. But again, in relation to exits, it's about, for me, and everyone's different, it's about, first of all, predetermining what I'm going to do with my exits. So, one third out at anywhere from 5 to 8 ticks, the second third anywhere out from, say, 8 to 10 ticks, and then the final third anywhere from, say, 10 onwards. So this particular case, but even though that's predetermined, then I decide based on the 15-minute charts and based on key levels and where this market's heading as to ones I can go for more. And this one here, if I was in, prepared to go for more. This one here, not prepared to go for more, it's just not the right area. Okay, moving on from there, I didn't mention too, I've got a key level here at 14.13. So 14.13 is a support resistance level when you look at back over the days and the weeks. So from now, the market really started to tighten up. So this is where, for me, there wasn't enough movement to get on and take these particular 4 setups, but I'll go through what I was looking for. So this is the momentum, or my version of the 5-minute fade. Okay, so the market pushes up through a key level, moving average is starting to point to the upside. Needed to come back and buy off the key level there. So would have went a little bit, come back a little bit, then eventually went. Then this is like another version of the reversal. So this one here, it's an area where we pull back. Potentially the market should go higher from before suddenly we start breaking that pivot and all the other markets going with it. Look to sell there. So all the other markets were breaking that pivot as well. But again, there's just the market range is just too tight to be looking at that particular setup as well. This little arrow indicates a continuation trade. So again, market range too tight, but the setup is basically my version of the 5-minute buy. We've got a downtrend, pull back, get through this key level, come back, use it as resistance. So what I needed to do here is see it go past by 4 ticks, come back, use it as resistance, and then push lower. That's the concept, but certainly, you're looking at that. It's not like I've got a downtrend and a pullback and then a continuation. Okay, I just want to put that in there to kind of explain the area. But when you look at the overall trading area, 1, there's not enough of a range, and 2, it's just that the setup doesn't look quite right. You need more of a push down here, and this pullback needs to be a bit smaller. You don't want a pullback coming all the way back to the highs. It just changes the area, but still worth explaining. And then this particular trade here, this was my version of the breakout. So I go to the 1-minute chart here. So what I'm waiting for is the predictive average looking to start crossing up and looking for it to potentially push through and break the highs. But what I do is look for a key level. So this is the region around here when I'm looking at the trade. Straight away when I look at the chart, so I could see 14.14 was a significant level in the market. You can see this is where we spiked up here, got underneath it, uses the resistance, and now here it's starting to come up through it. So what I need here is power through the region, come back, use it as support, and then buy and go higher. So look to buy here. So once it pushes 4 ticks or more through, put on the order to buy off the support level, and again you can see very, very tight and just pretty much went nowhere from there anyway. So that's it for the day. Just the 1 break-even trade and the 1 no fill, plus these other setups. I mean, I call them setups. What I do is I record 2 sections. I record what I call actual setups, where I physically get filled like this one here, or I'm physically got the order on. I just didn't get the fill. I was just waiting, but never got filled. But then there's others, what I call potential setups, where even though I was looking at them just for interest sakes, but some of them are a long way from actually becoming a trade. For example, this continuation and selling down here. I was far from ever taking that, but I'm recording it just for interest sakes as to get an idea of what the market's doing. But the concept is, as the moving average is starting to push down here, I'm now looking for my 5-minute sell version of the trade, where I look for it to hit resistance and push lower from. But it's not like I'm actually looking to physically take the trade. So that's where these little arrows indicate, its potential areas that, some of them were actually a long way from becoming a trade. Obviously I'm not looking to take that, 7, 8 trades a day. I just don't do that. So that's my breakdown of the day. Even though it's a day of quite tight range, there's still plenty going on, and that's what I mean. There's always opportunities, and if you stick very tight to a systematic process that you're very, you're confident in and know exactly how to execute it, and that's what really needs to be the focus, is having something that's systematic, that you feel very confident in executing, and you know exactly what to do. There's no grey areas. Even in times like this when the market starts to slow down, you want to have a process for how you deal with everything, and then just practice implementing it every day. That's why I do this blog. For me, it's all about just consolidating exactly what I'm looking for, and doing this every day. You soon get very clued up on exactly how you like to trade. So anyway, we're back on Tuesday.